We're so excited you're joining us here on Retiring Well. We got an action-packed show coming up for the next half hour just for you. First, we're going to be talking about the importance of investment plan flexibility. What does that mean, and how can you know if your investment plan is flexible? Then Nick is going to join us and talk about the benefits of getting the money out of your 401k later in life. Joe is going to join us about the 4 mistakes that you might be making with your target dated funds. Commonly used in 401k or other retirement plans, do you have them, and maybe something you should be watching out for? And to wrap up the show, Virgil is going to come on and talk about the specific financial challenges that physicians may face when their working years along in their retirement. Hopefully you find this so informational and valuable so you can plan to retire well.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
Welcome to another episode here of Coffee Talk. John Torbett and Art Canfield here. Want to talk about investment plan flexibility with you today. And what does that mean? Well, we've yet to meet somebody, and I don't know if you have, where they can predict the market, right? Wouldn't that be great? The crystal ball of knowing exactly what's going to happen next, the ups and downs and the sideways in the market. So, with that said, especially somebody that's nearing or in retirement, being invested appropriately no matter what does happen, right? There's things out there that are looming, good, bad, or indifferent, but having that plan flexibility, so no matter what happens, you're able to continue on and live that retirement dream.
Yeah, I think of an example, Art, of maybe a plan that didn't work out where the people wanted to be flexible, but may not have been the best decision. And so think back to the COVID time in 2020. Markets didn't cooperate and markets dropped there in a short amount of time. Well, in their mind, even though they had a well-diversified plan and it was with time, it would have made its way back up pretty well. At sort of the bottom point, they said, nope, markets are gonna completely crash, and we need to go put all our money basically in CDs at the bank and everything. And so that now all of a sudden they put themselves in a position where, yeah, they didn't have any risk in the portfolio, but now their earning potential had pretty much dissipated, and so and they had committed for 12 months, 24 months, 36 months to a structure in which they ultimately weren't taking risk, but their returns were nominal. And so again, it's one where that emotional reaction sometimes isn't going to be the best for your plan. And so you want to take that into consideration when these black swan events occur, because they're bound to happen.
Right. Absolutely. I think back to, when we do these plannings for people and having these conversations, it's times like that we find ourselves in recently where the markets have been good. We've come off a couple great years. If you've been invested in U.S. like domestic type equities, stuff like that, you felt really good about your returns. Well, it isn't always the up and up, right? It isn't always that, and there's those unpredictable things. Your story was around kind of the pandemic and that sort of period. A lot of times the market refers to them as these black swan events, these events that nobody sees coming, unpredictable in nature. It's really a good time for you out there, if you're somebody that's nearing or in retirement or at a point where you might start needing some of this money, to start asking yourself some of these hard questions. When folks come in and meet with us here in one of our Northern Michigan offices, we sit down and we start talking about that. What are you comfortable with? What level of risk are you comfortable with? That uncle point. Envision yourself, close your eyes for a minute. You open up your 401k statement, your IRA statement, investment statement, and you have a number on there that last month it was X dollars amount. Let's say it's $300,000. You had $300,000 in this statement, and then the very next month the market was horrible, and now your $300 is down 20%, and you lost $60,000 over the course of that month. What would you do? How would you react? How would you feel? Most people say, well, I don't know. But think about it. Is that too much for you? And then analyze that with your current holdings and what that maximum exposure is.
Yeah, and one of the things that we offer at Centennial Wealth Advisory, you can dive in behind the scenes and basically look at, from a historical perspective, sort of how has your portfolio performed, and during these potentially different black swan events, how have they performed, and try and project in future times when the markets are either really strong or not so strong and you're seeing a pullback, what type of return would you anticipate? And so those are tools that we have available that we offer up to you, no cost, no obligation. Sit down and review that and try and determine, again, sort of what is that uncle point? Where are you most comfortable with your portfolio? And so that way you know going into a certain type of investment, hey, here's potentially what this might look like, and ultimately then, is that something you're comfortable investing in?
Absolutely. And I can hear you, some of you sitting out there watching the show and say, John, the markets always come back. They're cyclical. Trust me, we've heard it, and we see it. Run those numbers when you're taking money out as an income plan. See how that feels at that point when the market, your account loses 20, 30% and you're living off of that money and pulling money out. See how that feels for that. We can tell you, being in this business for a while and helping people with income plans, I've yet to meet a person that really is thrilled when their account's down 30% and they're relying on that for income. Those conversations become much more real when that is really the case. So now is the time to be looking at this before something like that happens. Times are good right now. Explore that option. Give us a call. We'd love to sit down with you to review this so you can plan to retire well.
You've worked hard. Plan to retire well. The success of your retirement depends on a sound plan. If you are retired or nearing retirement, we invite you to an informative live event to help you plan to retire well. There is no cost and no obligation, and dinner is on us. We are Centennial Wealth Advisory, financial professionals specializing in retirement planning and serving all of northern Michigan, with offices in Traverse City, Gaylord, Petoskey, and Cadillac. Our presentation will address important topics such as inflation isn't dead yet. How are you protecting your retirement income? Could the looming Social Security shortfall change the course of your retirement? How potential tax changes could affect your retirement income? What impact will the administration changes have on your retirement? Smart estate planning to minimize taxation, and much more. Call 888-608-5825 or register online and choose the date and location that works best for you. Wednesday, May 7th at Soralina in Traverse City. Tuesday, May 13th at the Stafford's Perry Hotel in Petoskey. Wednesday, May 14th at Treetops Hunter's Grill in Gaylord. Wednesday, May 14th at the David L. Eisler Center in Ferris State University in Big Rapids. Thursday, May 15th at Boone's Long Lake Inn in Traverse City. Or Tuesday, May 20th at the Bluefish Kitchen and Bar in Manistee. The live event starts at 6:30 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and tends to fill quickly. Call 888-608-5825 or register online to reserve your seats today. Don't miss this important live event to help you plan to retire well.
Have you ever heard of a 401k rollover? Well, if you've watched this show long enough, you've probably heard us reference that in the past. But what I've come to find is that a lot of prospective clients, they hear the word 401k rollover and they think, well, I can't really do that until I retire. And that's actually incorrect for the most part. Okay, there's what's called an in-service rollover that allows you the ability to do that rollover before you even retire. Now, every plan, employer plan, is a little bit different on their rules and regulations for that, but most plans allow you to do what's called the in-service rollover at age 59 and a half or older. Okay, now I've seen it where some plans it's not until age 60 or 62 or so forth, but you'll have to check with your plan provider on that. But nowadays, most plans allow you to do that rollover while you're still working as long as you hit that magical age, okay? Now, why would you want to do that, right? What are the benefits? Well, that's what I want to talk about today. So I'm going to go over 3 main benefits of doing that in-service 401k rollover even before you retire. The first benefit to doing that is going to be that it allows you so much more investment options, especially when you need it approaching retirement. Because what we found is with these 401ks is that they're essentially set up for growth and accumulation, and they should be, right? I mean, you got so much time on your side, 30, 40 years working, you want to stash away as much money as possible. But then once you get to that retirement age or approaching retirement, typically there's a fundamental shift in your investment philosophy. You go from that growth and accumulation phase to now it's more preservation and eventually income in retirement. And those 401ks, they really aren't set up for that kind of investment philosophy. I like to think of it as, within that 401k, you've got a menu of investment options, and there's probably a dozen or more that are growth and accumulation style, more risky investments, maybe a half a dozen or so in the bond or more conservative, and then maybe one or two options in that cash or money market space. So you're very limited. Your hands are tied, if you will. And so once you get closer to retirement, or in retirement and you want to get more conservative, it's often in your best interest to get your money out of that 401k, roll it to an IRA while you're still working, and open up the entire investment world to you. So that's a huge benefit, benefit number one. Number two would be tax planning. Okay, so within those plans, those employer plans, there's often not a lot of tax planning that you can do within that 401k. Now, every once in a while, I'll see a plan where they do allow in-plan Roth conversions, but for the most part, that's very rare. So the only way that you can kind of start the tax planning game a little sooner than after retirement is by doing the in-service rollover, getting the money out of that 401k over to an IRA, and then you can do some tax planning. You can do Roth conversions. Get Uncle Sam out of your pocket even before you retire and have that money grow tax-free throughout retirement. And then finally, the last huge benefit to doing these in-service rollovers is it offers you more control of your investments. I hear it so often where prospective clients come into the office and they say, hey, I called my 401k provider just to ask some simple questions like, hey, what's my distribution options? What's my balance? What are my different investment options and so forth? And they call them up and the other person on the other line barely speaks any English whatsoever. And when you're talking about hundreds of thousands, if not millions of dollars, not being able to thoroughly understand what that agent on the other line is actually saying kind of puts a bad taste in your mouth, right? It doesn't give you a lot of peace of mind, especially as you're approaching retirement. So by doing these in-service rollovers while you're still working, kind of planning ahead for retirement, you take the money out of the 401k, roll it to an IRA with a financial advisor like us here at Centennial. We'll sit down with you, we'll look you right in the eye and customize your investment plan for retirement. Okay, and all of us here speak English, okay? But, that's a huge benefit. Being able to, sit face to face and discuss and customize your investment plan is so important, especially as you're approaching retirement. So don't hesitate. Give us a call, schedule a no-cost, no-obligation consultation, and we'll be happy to help you plan to retire well.
Let us help you guard your golden years in an effort to turn your retirement dreams into reality. Learn about proven strategies to help you combat the impact of falling interest rates and explore attractive alternatives. Simply go to send-wealth.com. Scroll down and click the link Helping to Guard Your Golden Years to receive your free copy of our valuable and informative white paper, Helping to Guard Your Golden Years.
We think about target date funds for investing. I kind of have a love-hate relationship with these, and anybody that's come in for a meeting, that's watched the TV show and we're talking about allocation, we dig into these funds, you kind of know what I'm talking about. They can be a great tool, but they're not the silver bullet to investing and certainly not the end-all solution to retirement planning. But these target date funds have really grown over the last few years. So year end of 2023, there's over $3.5 trillion in these target date funds. A big reason for this is we tend to see these funds in like our 401k plans, 403bs, 457bs, so think employer-sponsored retirement plans. They tend to be the default option. So if you transition to a new employer and you start saving to the 401k plan, and if you don't go in and pick your funds automatically, you're usually grouped into one of these target date funds. So today we're going to talk through kind of what these are, and then pros and cons and some maybe different solutions to using them. Well, what a target date fund is, it's just really an overall allocated portfolio, kind of diversified between stocks and bonds, and then it's adjusted proactively based on your retirement date that you input. So they tend to go in 5-year increments, so 2035, 2040, 2045, so on and so forth, as far as what date you expect to retire. As you get closer to that date, those funds are going to adjust the stock bond allocation to be either more aggressive or more conservative, ideally getting more conservative as you get closer to that date. Now, some of the problems with target date funds that we'll talk through is, well, you don't have a lot of input into that. And if you've ever seen some of our other information around asset allocation, and I would encourage you to check out some of our other YouTube videos on different thoughts on asset allocation, what they're automatically doing for you may not be the right fit for you. And what we'll oftentimes see is the allocations they're moving into that are supposed to get more conservative as we get to retirement, that may not be actually the case. But first, let's talk about who these funds are good for. Well, in my opinion, they're really good for those kind of individuals starting out. So starting out saving for retirement. Reason for that is they give you some really nice broad-based diversification, across stocks and bonds, as well as domestic and international equities. What they do for you is they give you that diversification, but they also do it very cheaply. You're not paying a lot of fees for these. There's not a lot of active management going into these accounts, and they don't really have a lot of minimums. So again, it's really great for those starting out investing that really don't know how to pick and choose their different investments, or they're not working with a financial professional. But they do come with a lot of limitations. The biggest one being is you really have no control over what you're investing in inside of those plans. It gives you this base allocation. You really can't adjust that. So one of the things we talk a lot about and we see, so individuals coming in watching the show, they have these target date funds. Once we kind of dig into it, we'll find, as you're approaching retirement, they might have 30% international equities. That's a very high risk asset class to have a big holding in going into retirement. Or as we're working with some younger clients, they may be more concerned with socially responsible investing. You really can't have those types of strategies in these target date funds. They're just base allocation. You get grouped together with everybody else that's planning to retire in that 5-year period. That's really it. You really can't dictate how you want that invested to align with your risk tolerance or align with your values, beliefs, and those sorts of things. They're often used incorrectly as well. A lot of times we'll see a target date fund, but then someone will be looking at the performance of their other holdings that they have inside their 401k plan or that are available to them, and they'll say, well, I want that large cap growth holding. Well, as you add other elements to the portfolio, you really defeated the whole purpose of having that target date fund. And now maybe you're over allocated or under allocated in certain areas. And we want to try to have that diversified portfolio really align with that financial plan. But the biggest thing is, in my opinion, they're just not suitable for retirees. Again, you have no control over what you're invested in. You also have no control over where you're pulling money from. So if we're in retirement and we're taking distributions, in a year when the stock market's doing really well, we may not want to sell our stock holdings in that year. We may want that asset class to appreciate. We don't control that in a target date fund. Vice versa, if the equity market's down and we're taking distributions, well, we're selling those accounts at losses. Everything is correlated to the stock and bond market in these funds. We really have no control over where we're pulling that income from. So what we want to think about is, for using target date funds, not to suggest that they're bad, but let's take a look at all of the holdings that you have inside those plans and all of the holdings in the investment universe, and start to align everything with your values, your beliefs, your overall financial plans, and start to put this in place to really align with your goals long term. If you don't know where to start with this, we have a whole team of professionals here at Centennial Wealth Advisory where we can sit down with you, analyze all these different investment tools, and come up with the best plan for your needs.
You've worked hard. Plan to retire well. The success of your retirement depends on a sound plan. If you are retired or nearing retirement, we invite you to an informative live event to help you plan to retire well. There is no cost and no obligation, and dinner is on us. We are Centennial Wealth Advisory, financial professionals specializing in retirement planning and serving all of northern Michigan, with offices in Traverse City, Gaylord, Petoskey, and Cadillac. Our presentation will address important topics such as inflation isn't dead yet. How are you protecting your retirement income? Could the looming Social Security shortfall change the course of your retirement? How potential tax changes could affect your retirement income? What impact will the administration changes have on your retirement? Smart estate planning to minimize taxation, and much more. Call 888-608-5825 or register online and choose the date and location that works best for you. Wednesday, May 7th at Soralina in Traverse City. Tuesday, May 13th at the Stafford's Perry Hotel in Petoskey. Wednesday, May 14th at Treetops Hunters Grill in Gaylord. Wednesday, May 14th at the David L. Eisler Center in Ferris State University in Big Rapids. Thursday, May 15th at Boone's Long Lake Inn in Traverse City. Or Tuesday, May 20th at the Bluefish Kitchen and Bar in Manistee. The live event starts at 6:30 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and tends to fill quickly. Call 888-608-5825 or register online to reserve your seats today. Don't miss this important live event to help you plan to retire well.
Let us help you guard your golden years in an effort to turn your retirement dreams into reality. Learn about proven strategies to help you combat the impact of falling interest rates and explore attractive alternatives. Simply go to send-wealth.com. Scroll down and click the link Helping to Guard Your Golden Years to receive your free copy of our valuable and informative white paper, Helping to Guard Your Golden Years.
Working with hundreds of physicians over the last 15 years, I've had a firsthand experience to the struggles physicians face when it comes to their finances. Today, I'm going to look at different things that do directly impact physicians in their financial wellness. Some of those things include high student loan debt, delayed income growth, lack of time to manage their finances, retirement planning, and complex tax issues. When it comes to high student loan debt, most medical student graduates come out of medical school with over $200,000 in medical school loan debt. I actually met with a couple before, physician couple, and they had over $1 million combined in student loan debt at 6.8% interest. So obviously the student loan debt and that burden that you carry as a physician can really be detrimental to you getting started with your savings and investing. Another area we look at when we talk about physicians is your delayed income growth. So most physicians, as if you are one watching this, know you go to 4 years undergrad, 4 years of medical school, and then do a residency or even possibly a fellowship in addition to your residency. So the reality is you're not hitting practice, earning your future income or higher income until you're in your late 20s or early 30s. So the reality is if you had friends that you went to undergrad with and they got their 4-year degree and went to work, that can really put you behind them when it comes to saving and investing for your future, at building assets, buying a house. All of these things get delayed because you're in training and you're not earning your ultimate income that you will when you're in practice. Different ways physicians are paid, and again, if you're watching this as a doctor, you know this, but there's a different styles of ways physicians are compensated. So that could be that they're paid a salary. It could be your paid salary plus maybe an RVU bonus. Another way might be if you work for a private group, it might be a percentage of your collection. So lots of different ways you may get paid, and obviously your compensation also will depend on if you're working for a not-for-profit hospital, if you're medical group or private practice, and then also where you're located. If you're in a small town, big city, and then of course a big determinant is your specialty itself.
Another thing that's really hard for physicians is just a lack of time to manage their finances. As a physician, obviously you have a very demanding schedule. There's quite a bit of burnout in physician space, and that can be contributed to a lot of different things. And this is really coming from my conversations with my physician clients. It could be just overall stress of their job from patient quotas, the bedside care as they call it. You're put through the ringer really when you work for a hospital group or medical group with how many patients you're supposed to see a day. They've really increased the quotas, obviously trying to affect the bottom line here, but the stress that puts on physicians is real. Time constraints with your job, as far as how much time you have outside of work. You're expected to do a lot more at your job, maybe carry more responsibilities than say 10, 15, even 20 years ago. So all those factors really can put in an issue with your time to manage your own finances because you're so worried about your patients, and then you've obviously got your other responsibilities outside of work. I think that really speaks to then the fact that it's important to have someone you can trust, a professional you can turn to help you manage your own finances, and so that you can understand what your options even are with regards to your finances. Another piece is retirement planning. So there's a lot of different things to look at with regards to retirement plan. Whether you work for a 501(c)(3) at a not-for-profit hospital, a medical group, or you work at a private practice, through your employer, you have a lot of different options when it comes to work retirement plans. You look at have possibly a 403(b), a 401(k), a defined benefit plan, thrift savings plan, or the TSP. So there's a lot of different options there, and in knowing and understanding what's the best for you, should you make pre-tax or post-tax contributions is very important, and having that plan in itself is important. Outside of that, there's lots of other options. I haven't met a physician who didn't tell me they wanted passive income. So there's other options you can invest in. Of course, you also have your individual retirement accounts or Roth IRAs, brokerage accounts. These are all things you can think about and look at when it comes to retirement planning. The other thing to think about is tax issues. So there's multiple obviously income streams with physicians typically. There's all kinds of different tax issues, multiple income streams you have to concern or worry about, possibly changing or varying tax rules, and just overall complex tax situation for most physicians. If you're a physician and you're watching this out there and you would like to sit down for no cost and no obligation meeting to meet with myself here at Centennial Wealth Advisory, I'd be happy to meet with you. Just follow the information on the screen, and we'd love to meet with you so we can help you plan to retire well.